this year I can honestly say that for the most part, other than some numbers changing, the tax laws have not changed anything that I know of specifically this year. Whenever. Anyway, my claim to fame and so forth, I've been preparing taxes for, 17 years. So I've spent 12 of those 17 as a professional tax preparer, half of them working for that little outfit called H&R, and the other half working for a CPA. And in the process, I learned why people come to a CPA for tax preparation. So what we used to call hard tax returns for H&R, we call the easiest ones for the CPA. But anyway, my other claim, I also provide the technical support for the AARP Tax-Aide program for the state of Washington. So I get to travel all over the state, creating chaos for various people and so forth, trying to keep some out of what they have to do. So anyway, what we're going to talk about today, I'm going to give you a brief rundown of how the IRS collects their money and so forth. Want to make you aware of things that are happening for your return that you're preparing this year. In 2017, you are preparing your tax return for the tax year of 2016. So I'm also going to cover a few things, changes in the tax law that may affect you for the coming year. We're going to do a brief thing on the Affordable Care Act. We have no idea right now what you're doing is, since you're preparing a 2016 tax return, that's the ACA as it currently exists. What's going to happen next year is anybody's guess. So finally we'll get into the commercial part of it, and that's actually preparing your 2016 tax return. So what happened for the 2016 tax returns season and so forth. This was the tax year 2015. So there were roughly 151 million individual tax returns prepared last year. And the IRS collected a little bit over $3 billion in that. So of that, 53% of it came from individuals. You, me, and the rest of the country. So there were 131 million returns filed last year, of which 78 million were provided by the tax professionals, and another 53 million were otherwise prepared. There were 110 million refunds for about 305 billion. The average tax return was just under $3,000, the actual refund. So, okay. One of the things that most people don't understand and so forth about preparing tax is the average dependent doesn't file a tax return. Essentially, they're carried on the parent's tax return. But if a dependent has more than $1,050 in what is called unearned income, this is income received from interest, dividends. In other words, most of this is people who are providing assets to their children in an attempt to avoid having to pay the tax on it themselves. Well, the government decided we're going to play this game a little bit differently. So any dependent that receives more than $1,050 still has to earned income, still has to file a return. If they make more than $6,300 of earned income, in other words, they get a W-2, they have to file a return. Basically, what it boils down to is if you have gross income greater than $1,000, you're probably looking at having your dependents file a return. I'm going to talk a little bit later about something called the kitty tax. So, anyway, onward. The income tax rates for this year are the same as they were last year. And I'm not going to go through all those. Essentially, your minimum tax is going to be 10% of your taxable income, which is different than your gross. And it goes all the way up to 39.6%. This is the one that you can probably, that particular rate, I strongly suspect is going to disappear this year. So, and capital gains rates, this is the way to make money if you've got stocks or you invest in various things and so forth. As long as your income is below the 15% tax cutoff, which for people married filing joint is around $79,000, you don't pay any capital gains tax.
How about single?
Say again?
Single person making over that.
Single person is down around 40,000. So, the next, for all the rest of the brackets, except the last one, you're only paying 15%. And so these are the brackets where you would normally be paying 25 to 35%. You're only going to be paying 15% on capital gains. And finally, those in that top tax bracket pay 20%. And there's a few other little glitches that come along with it. So one is when if you're receiving dividends and you get a 1099 div, those things that are called qualified dividends are essentially taxed at the capital gains rate, whereas ordinary dividends are taxed at your normal income rate. So you can also, you've got child care. If you are paying for child care in order to work, you can get a child care credit. It's my strong opinion that this is primarily a reporting scheme the IRS has dreamed up to get you to tell them how much child care people are getting paid. You get the credit is based on $3,000 for one child, or up to $6,000 for more than one. But the actual credit is down there. It depends, it's between 35 and 20% the actual expense that you incurred. So, plus you've still got, if you're one of these souls, I don't think anybody here is that far back, but still, if you're still paying on a student loan, you can get a adjustment to your income up to $2,500 for student loan interest. Okay, last year there were a number of things. For a long period of time, what we were seeing was what they call tax extenders were being passed on a typically biannual basis and so on. One of them was the fact that you could deduct sales taxes instead of the state income tax. That was important to people in this state because we don't have a state income tax. So actually, they made it apply to anybody in the country. Essentially, if you pay more in state sales tax than you do in state income tax, you can claim the sales tax deduction rather than the income tax deduction. They also made the American Opportunity Education Credit permanent. It used to be that we had something called the Hope Credit, which was good for 2 years of education. And they changed it and so forth to 4 years. Of course, in the process, they also limited how much you could actually get out of it. So they also provided the ability to make tax-free distributions from IRAs. If you happen to have an IRA and you are generous and wish to donate money to a charity, and you are over the age of 70 and a half, you're required to take what's called a required minimum distribution from your IRA. So if you so choose, by the way, that distribution, of course, is taxable at your ordinary income rate. Now, if you want to donate that required minimum distribution to a charity, you don't pay any tax on that money. Essentially, the charity gets 100% of the RMD. It costs you nothing other than the fact that you're donating the money. So if you want to donate the money, that's a good way to get it, because this deduction is allowed without itemizing. And we're going to talk a little bit more about itemizing as I get farther down into this. So, but that's the big advantage, is you get the distribution for a donation without having to actually itemize on your tax return.
And it's not just charities, it's also most nonprofits. That kind of confused me first.
Well, yeah, it's anybody that's a 501c3 organization. So, okay. The other is K-12 teachers can deduct their expenses that they have. Most teachers spend money to help their students and so on. So they are essentially allowed up to $250 directly off of their adjustment off of their taxable income. So, okay. One of the things in the process of making those were all made permanent. So essentially, there's no further tax law adjustments by Congress that need to go on. So they did extend a few other things through this year. So this is the last year you'll be able to claim any of these. One of them is if you had a residence that your principal residence was foreclosed upon and so on, essentially the amount of money that they foreclosed or you did not pay to the lender was taxable income to you. So they essentially allowed you to exclude that particular income from your tax return. So the other thing is that if you are borrowing money to pay for a home and you didn't put a 20% down payment, so forth, typically the lender required that you take out mortgage insurance, which essentially says if you default, the mortgage insurance company has to pay for your mortgage or close out the mortgage. And so they have made premiums that you pay for that mortgage insurance deductible. Starting next year, that's not going to be. And I don't know if that's going to be changed or not. In addition, as an alternative, there is an education credit. This is the American Opportunity or the Lifetime Learning Credit and so forth. If your income is such that you don't qualify for either one of those, you may qualify for up to a $4,000 adjustment in tuition and fees. So, and that once again is something that's going to go away after this year. This year, the standard deduction is going to be $12,600, the same as it was last year. If you're single, standard deduction is only $6,300. And if you qualify for the head of household status, it's $9,300. That's the only one that actually went up this year. So for 2017, the standard deduction is going to go to $12,700, up $50 for single, up another $50 for head of household. So essentially what that says is that if you are over 65, because you get an additional $1,250 per person over 65 on your tax return for the spouse and the taxpayer. The single person gets to add $1,550 to it. So essentially, that puts the standard deduction for seniors, both filing married, filing joint, and so forth, at $15,100. So that says that a senior couple filing married, filing joint, essentially the first $23,000 of your income is tax exempt. So to qualify for the head of household, you have to have what's called a qualifying child living with you. Okay? And there are interesting restrictions on qualifying child as opposed to what they call a qualified relative. And oddly enough, once your child exceeds the age of 18 or 24 if they're in college, they become a qualified relative, not a qualified child. And the rules for qualified relatives are different than qualified child. So the personal exemption this year, we're up at $4,050, and it's going to stay the same next year. However, that exemption phases out. So if you're, again, married, filing jointly, anything over $311,000, you start to lose your personal exemption. So it goes up, these numbers go up by about $2,500 for next year.
What is HOH?
Head of household, I'm sorry. So this is where, again, you have a qualifying child living with you, which means a child, your child, under the age of 18. Actually, under the age of 19. 18 or less. Okay, if you are itemizing your deductions, that also gets phased out. In other words, how much you can claim. I don't know if there's anybody here that would be affected because of the income rates at which they start to phase out. So I used to see any number of them with my, when I was working for the CPA. But essentially you can't, they won't take more than 80% of it away. So, okay. If you've got investment income and you have more than, again, married, filing joint, you have income greater than $250,000, you're going to find a 3.8 essentially tax surcharge that is applied to your investment income. And investment income includes rentals income and so forth. Anything that you it's essentially, again, unearned income is what gets taxed at 3.8%. If you adopt a child, you can get a credit for that up to $13,400. Again, it depends on your income as to how much of that $13,400 you get. The residential energy credit has been around since 2007, and most people who are eligible for it have already exceeded the $500 that is the limit, and that limit is everything that you may have claimed since 2007. The itemized medical deduction, again, those over 65, it used to be 7.5%, what we call the haircut. In other words, you lost the first 7.5% of your income against medical expenses and so on before they started to count. Again, you had to itemize in order to claim this. So starting next year, everybody gets the 10% clip. So, and if you, even though the threshold for Social Security tax, it was $118,000 this year, at the point at which you had, if you had that kind of income, you no longer had to pay the Social Security portion of the Social Security tax and so on. You still had to pay the Medicare. For 2017, that point is going up to 127,000. So, and on top of that, if you've got income if you're single, you've got income excess of $200,000, you get an additional 0.9% tacked onto your Medicare tax. Okay. One of the big things that we get into in the tax game and so forth happens to be a child's exemption. This is that $4,000 we talked about. When you have two parents that have divorced or separated and so on, one becomes the custodial parent of the child, the other one is not. Essentially, the exemption goes to the custodial parent unless that parent decides to give that exemption, which accompanying the exemption happens to be the child tax credit, that $1,000 and so forth. So what it boils down to is the change in the law. They have a form called an 8332, which allows the custodial parent to allow the non-custodial parent to claim the exemption and the child tax credit. So essentially the custodial parent is whoever the child lives with for more than half the year. So normally in 365-day years, that's easily covered. So they've got other rules for leap years and so on. Basically, they talk about more than 181 nights that the child spends with one or the other of the parents. So, and the reason for the 8332 is they're trying to get away from the problem of who files first. Quite frequently, what has happened in the past is that the custodial parent doesn't file until after the non-custodial parent, and at that point they find out the non-custodial parent has already claimed the child. That then is something that gets turned over to be argued with the IRS. The IRS doesn't like to get in the middle of those. So it used to be that you could get the divorce decree decide who got the exemption, and they got rid of that because now they say if there's any conditions in the divorce decree, once again you need the 8332. And since virtually all the divorce decrees usually include some kind of condition, normally it's that the parent pays child support or pays for medical care or something of that nature. Anything in that line immediately means that the divorce decree is no longer valid as far as who gets the child. Taxpayer. You've got to live with somebody who lives with this thing 65 days a year. And I don't like to write it out. So, okay. And that's what I just said. Okay. One of the other things that people have often forgotten about, and this is something that's more or less happened in about the past 6 or 7 years, is cancellation of debt. People walk away from their credit card debt. We already talked about walking away from a home mortgage and so forth. If you have credit card debt that gets discharged by the credit card company, that is considered income to you. Essentially what's happened is you have charged this stuff, and that money now becomes income to you if you don't pay it back. So essentially the lender turns around and issues the taxpayer with a 1099-C that says, we gave up this amount of money. So, and right now almost all of it comes from credit card debt. However, if you are in bankruptcy or you are what are called insolvent, in other words, if your assets are less than your liabilities, you're considered insolvent. certain student loans. Virtually all these student loans that get canceled have to do primarily in medical situations where doctors agree to practice in a very low income area and so forth for a period of time. Then they can cancel their student loan. For a doctor, that student loan typically is in the hundreds of thousands of dollars. So it's one good way to get rid of it. And then the foreclosure on your personal residence and so on that we talked about earlier. Okay. Sales tax reduction, of course, comes with conditions. Like I said, you're talking about 15, you've got to have deductions in excess of $15,000 before it makes it worthwhile to itemize. So the two biggest things that show up on itemized deduction Schedule A and so forth, one is mortgage interest and the other is property taxes on your home. So in this state, we don't have, you can't claim the registration tax for your automobile because it is not a property tax. So forth, it is not based on the value of the automobile. So the third one, of course, is charitable deductions. Those are the three big items, and to a certain extent, if you're really sick, you may have enough medical deductions that they start to count as well. Once again, medical deductions, you've got to be, although they include premiums, and the average person today probably pays close to $6,000 to $8,000 in medical premiums per year, but you've got to remember that's being shaved by 7.5% of your gross income.
Question. On that previous screen, so if you're like a medical student and you have a $100,000 loan you want written off, you have to go work in a low-income area?
That's right.
How long do you have to work in a low-income
Usually
area?
it's 5 years.
You have to work 5 years. Are you getting paid?
You're getting paid for the services you provide in that low-income area, but once again, you're probably dealing with people that can't afford that in the first place. So
how are you getting paid if they can't afford it?
you're getting paid by the people that can. Yeah. So, yeah, I mean, it isn't, it isn't 100%, but that's the conditions for the write-off. So, not, oddly enough, not too many doctors do it. I mean, it's doctors, dentists, and so forth. There are, those that are in that business know about it when they get out of school, believe me. Okay, we already talked about state income tax versus sales tax. As far as sales tax deduction is concerned, if you want to keep records of all the sales taxes you pay, you can actually use those numbers on your tax return. But as an alternative, the IRS provides tables based on your income and the number of exemptions that you have, and so on. So, plus they don't take into account purchases of vehicles, boats, airplanes, or major home improvement purchases and so forth. So, in this state, when you buy a vehicle, it turns out there's an additional 0.3% tax on the vehicle, sales tax on the vehicle. You're only allowed to take the tax that is normal for everybody else, and so on. So you have to reduce your vehicle sales tax by about 0.3%. And if you've got the tables that the IRS provides are strictly for the state tax rate, which in this state is 6.5%. So you get to add your local sales tax rate, and in this county it's 8.5%, or 8.7%, pardon me. So that's about 134% of the base rate. And so two people living in Kitsap County with an income between 50 and 60,000, they get about $1,000 deduction. So again, this is all working against that 15,000 that if you're seniors and so forth. So, and it is finally was made permanent.
Can you take the sales tax deduction if you don't itemize?
No, that's the hiccup that goes with
Not
it.
even the table?
No,
Okay.
it's strictly, it's tax, it gets added to your property tax and so forth. And any property taxes you pay on, land or anything of that nature and so forth. So, okay, they've got this new American Opportunity Credit. In order to claim this, you must be pursuing a undergraduate degree. It's only good for the first 4 years. It replaced the Hope Credit. They now allow you to include books, and in this year they are now allowing you to include computers. They recognize the fact that attending college are virtually mandatory that you have a laptop with you and so on. So, but it does not include room and board. Yes?
Does this work with online also? Institutions, or?
If the student is actually pursuing a degree, okay, one of the other requirements that's coming up is that the educational institute has to issue you a 1099-T, or 1098-T is the form, that shows how much you paid in tuition, and you've got, if you're buying books and that sort of thing, you've got to have records of the books that you purchased. So as long as it is if the online university is something that is considered a proper educational and so on, which essentially says if the institution can accept student loans, okay, can use student loans to pay for the tuition, then they are an authorized educational institution. So the big thing has to do with room and board. Yes, go ahead.
These education credits, especially the last one, does that include 2015, or is this new for 2016?
The American Opportunity Credit's been in effect for about 5 years. So, in the past, you could not claim computers. That's something new this year.
I don't remember books being included, but I
But-
was looking for someone else.
Yeah.
The books, they had to be as part of the institution, they required it.
They had to be, yeah. And if typically, most of the time, if they were purchased through the college bookstore and so on, you can get away with it. So,
If you have to have internet access, does it include that?
say again?
If you have to have internet access, does it include that?
No. In other words, your ISP fees don't get included. The fact that you can just deduct the cost of the computer is half. The other side, of course, is that the limit that they will reimburse you for the American Opportunity Credit is 100% of the first 2,000 and 25% of the next 2,000. So essentially, $2,500 is the maximum you can get back. And so you're turning around, and of course, this is money that you spend. If you have a scholarship and so forth, the scholarship gets deducted first, and then it's how much is left over. But on the other side, you're looking at the first $4,000 is all that's covered in this. And I can't think of any institution that you can spend. You have to be at least a half-time student. So think of any institution where the tuition is going to be less than $4,000 a year. So the other side is that 40% of the American Opportunity Credit is refundable. This means that if you run out of tax that you have to pay, you can still claim up to 40% of that. It still shows up on your as a refund. So, unless the kitty tax applies. So, and the 1098-T, it does phase out some forth for somebody who is married filing jointly. It's going to phase out from 100% to zero by the time you hit 180K of income. They have something called a lifetime learning credit. Lifetime learning credit is good for any education. You don't have to be pursuing a degree. It just has to be something provided by an eligible education institution. And I've already talked about that. So, whoops, I see what. We're not going to do that. Something happened that I didn't realize. Okay. Anyhow, the lifetime learning credit applies to the first 10,000 expenses. However, it's limited to 20% of that 10,000. So you're talking about a $2,000 max. Not only that, but that credit is limited to the tax return. So if you have 5 different people, 5 different students, and so forth, you're still limited to a total of $2,000 for all of them. So, and once again, it phases out lower even than the American Opportunity. This is why we talked about the tuition and fees adjustment and so on. So, and it phases out between 130 and 160,000. The big thing is only the taxpayer or the non-dependent student can claim the education credit. You can't, if you're paying for your son's children or something of that nature and so on, essentially they get the credit, not you. So the best thing to do is give them the money and let them pay for the education. So other education benefits, they have something called the Cloverdale Education Savings Account. This is similar to an IRA. However, it is not deductible by anybody. The big thing is that anybody can contribute to it, and it's limited to $2,000 per year per individual. So, but the other side of this is that it can also be used for primary and secondary. So if you have one of your grandchildren and so forth wants to go to a private school and so on, and you start when they are first born, they can use that money to help pay the first 12 years of education in a private institution. But of course, it's at $2,000 per year, you're not going to build up a heck of a lot. They also have state 529 plans and so on, which essentially guarantee college at the current tuition rate. So it's a good deal from that standpoint. Okay, the child tax credit, it used to be $500, it's now $1,000, and that was something else that was on the extenders and has now been made permanent. However, it is phased out for higher income taxpayers. It's essentially reduced by $50 for each $1,000 of income. So, and the cutoff point for married filing joint is 110 is where it starts. They have the additional child tax credit. This is a refundable credit. So once again, if your tax prevents you from taking the child tax credit, in other words, you run out of the tax that you have to pay on your income is such that the $1,000 does not goes away before you've got less than $1,000 of tax due. Then you can now possibly claim the additional child tax credit. However, it is based on roughly 15% of the earned income. So if you don't have earned income, you don't qualify for the additional child tax credit. Okay. We've got the earned income credit. This is another one of the refundable credits. It depends on the number of qualified children, up to 3. They must live with a taxpayer. They don't have to be dependents. So, and not only that, but if you have a close relative living with you that is totally disabled, they may qualify you for the for the earned income tax credit. However, it's only good against, again, as I said, earned income. It's not good for money that you receive from pensions, stocks, or anything of that nature. Technically, you can, if you are under the age, let's see, over the age of 24 and under the age of 65, you don't need any kids. However, as soon as your income goes above $11,000, that goes away too. So, you've got to remember, the idea is to collect taxes, not give it back. The kiddie tax. This is something that it's actually been around for the better part of 20 years and so forth. Most people haven't paid much attention to it. So, essentially, this is the bit where parents put money into child savings accounts and so forth, or they purchase stocks for them or things of that nature. So, and it doesn't depend on the fact that the child is claimed as a dependent or not. So, as soon as their income exceeds the $10,050, the child has to file a tax return. And essentially, under an income over $2,100 becomes taxed at the parent's rate, not at the child's rate, but it's actually applied to the child's tax return. So, the alternative, of course, this means the parent has to file their tax return before the child. And the alternative is to just simply forget the fact that you're trying to avoid the tax on this income, and it all gets taxed on the parent's return. Finally, federal and state gift taxes and so forth. This is probably aimed much more at gift taxes than at the estate tax. The exclusion for this year, the maximum tax rate for estates is $40,000, but the exclusion is some $5 million. So unless you've got an estate in excess of $5 million, the only thing you have to worry about is the fact that this state charges somewhere between 10 and 19% on the state's value over $2 million. So the big thing is the lifetime gift tax exclusion for this year is $5,450,000. So the way gift taxes work is you're giving money to various people and so forth with the idea of reducing your eventual estate tax. you're trying to get the money out of your estate. So it turns out that a taxpayer and the taxpayer's spouse can each give $14,000 to anybody they wish and so forth each year. So that's $28,000 that you're getting out of your estate. And you can do that. If you want to give more than that $14,000, you have to file a gift tax return. However, you've got this lifetime exclusion. So as long as you're not going to give more than $5 million away over your lifetime, you eventually don't pay any gift tax. So you're only stuck for whatever happens at the final estate tax.
What is given money to a charity?
That's irrelevant.
Okay.
This is not deductible stuff. So typically it's parents giving money to their children and so on. So, and since both parents can each give $14,000 with no record whatsoever, that's it. If you want to give more than the $14,000 is where you've got to pay this other gain. The big thing on this probably is when you give a house. You've got a house that's worth $200,000, $300,000 and so forth to a child. That requires that you file the gift tax return in the year that you make the gift. However, in the long run, when the estate comes down, you've got the lifetime exclusion. So unless the house is worth more than $5 million, at that point in time, you don't pay any gift tax at the time when you actually get the house.
Is that $14,000 per child?
It's $14,000 per parent. Yeah, it's limited to a individual. So, but if you will, the taxpayer and the taxpayer's spouse can each give $14,000
But that's just
for to a individual. Yeah.
So if they had more than one individual, can they?
Yes.
More than
Each one can get the $28,000.
And they don't have to declare that as income.
They don't have to declare that as income. That's a gift, which is not taxable. And they don't have to file a gift tax return because it's less than the $14,000.
$14,000 a head,
Or less. Yeah.
$14,000 apiece.
Yeah.
The dependent doesn't claim it, but you, the giver, would claim it. It's your income, right?
No.
No,
You deduct that from your.
no.
It's not deductible and so forth. It's just money that you can give away. It's anticipation of the estate tax return is really what it's all about.
If you give away more than $14,000, you're not going to file a report, but you still don't pay any.
That's right. You don't pay any tax at that point in time. It isn't until you pass away that the estate files the final gift tax return, and as long as the exclusion is less than the $5,000 or the $5 million, there's no tax on that.
You're just taking your money out of savings or whatever
Yeah,
to give.
that's right. So it's the transfer of money in anticipation of avoiding the estate tax. That's really what it's supposedly about. But there are 100 other reasons why you might give the child money.
Sure.
This is...
Yeah, really, yeah, for sure.
Ta-da. Okay, another thing, when they pass the Part D prescription drug coverage and so forth for Social Security recipients, they essentially tacked on a surcharge based on income. And these are the tables and so on.
That taxable
So,
income?
and it's how much more, if you have a high income, you're going to be paying a greater monthly premium for your Medicare coverage. So, and essentially, as soon as your income goes above $428,000, you're going to be paying 220% of the standard rate and so on.
That taxable income? The 85?
That's adjusted gross.
Adjusted gross, okay.
Yeah, it's adjusted gross. It's not taxable. So, okay. This was all a game and so forth as far as how shared responsibility that was essentially passed as part of the idea being that they were going to coerce people one way or the other into obtaining health care coverage. So what's happened and so forth in this year, if you, one, is there anybody here who does not have medical coverage? Does not pay premiums one way or the other, either Medicare or however else. So, okay, then it's not going to impact you at all. Basically, those that don't have coverage this year are going to be hit with the $695 per adult. So, or 2.5% of their income. So,
You have to pay that on your taxes.
you pay that as part of, when you create your tax return, this comes up. However, there are a number of exemptions that get you out of it and so forth. One of them has to do with the affordability and depending on your income. Your income may be such that it is low enough that you aren't required to have the health insurance.
Question. In 2017, we don't know how that's going to go.
You're right.
I mean, but we're paying into it now.
No. You're paying for 2016 right now.
Well, I mean, the tax, but I mean, here it is, January.
Yep.
You have to have some kind of the Affordable Health Care Act is still in effect.
Yep.
You pay your monthly fees. It probably is going to be signed away next week. So, and you may still pay that. What I'm getting at is, this may go away where you have to pay in if you don't. If you decide to cancel your insurance sometime this year, you won't have to pay the tax again or something like that.
It's all going to depend on what Congress does and how they play the game. And they've already found out that there's a hell of a lot of people that are going to be upset if you totally wipe it out. So there were a lot of good things that came along with, the Affordable Care Act, and so on. So, yes, go ahead.
Go back to the next one behind this slide.
That one?
This one's the one before that. You have $134 paid to Medicare for high people.
Oh,
No, that's not how she
I thought that's what that said.
you're talking about this thing. In other words,
Yes.
yeah.
Unless your income is
Yeah,
higher.
in other words, this year you're going to be paying $134 for Medicare per month.
They shave that off your Social Security.
Yeah, correct. So, yeah, and if you're an individual with more than $85,000 in income, then your premium is going to be $187.50 instead of the $134.
So there's something to do with the people that are not on Social Security also.
If you don't, you still have to have health coverage.
Right,
And if
but
you're
the
not-
premiums are higher than someone who gets Social Security.
I'm not sure I understand the question.
No, federal employees, for example.
They're paid the same.
Yeah.
What's the story?
What's the story
Do
about?
you have to pay that if you're 65 and over, you don't want Medicare, you have to pay that?
No, but then you're stuck with the $695
Unless you have private insurance.
Oh,
unless you have
well,
private
I'm
insurance.
talking about, and of course, this year. But, yeah.
What-
If I was a dual
What's going to happen in
citizen-
2017, your guess is as good as mine, because it depends on what Congress does. And I don't know what they're going to do.
I wouldn't know how this works, Steve, you guys know, but if you're dual citizens of Canada and America, they have, the universal health care in Canada. Some guys may live up there to do that.
Yeah. If you have health care coverage, okay, as far as those of us preparing tax returns, if you tell us that you have health care coverage, that's all we need. We don't
You don't care
check.
what country supplies it.
That's right.
That's between you and the IRS.
In other words,
And in one country 6 months and in the other one 6 months.
once again, you tell your tax preparer, whoever's preparing your tax, that you have the health coverage for all year. They are going to believe you. They aren't the police. They aren't the tax police.
But for a lot of people, they didn't get the insurance because the $695 penalty was a bargain, and then they just show up at the emergency.
But you get nothing for the $695.
I mean, you pay a penalty, but if you need medical care, you just show up at the emergency room and they can't turn you away.
That's
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 what
what
the
they-
big complaint is too.
it depends on the emergency room.
Right, the hospital has the right to shut it down.
They'll turn people away.
They'll tell you to
Depends
go
on the hospital.
someplace
It's not a
else.
nice thing, but it happens.
Depends on the hospital.
And if, yeah, it's not
If it's a
life-threatening,
private
they don't have to
hospital,
do it.
they can turn you away.
Yeah.
Same with physicians.
Okay. So the shared, what they call the shared responsibility, is that your tax return that you're going to be preparing for 2016. Like I said, there's a number of exemptions, including affordability, and that's something that the tax preparer will sit down and calculate for you. So it's already too late for anything to happen for 2016, and I don't know what's going to be the situation for 2017. So, but depending on where you may have been eligible for financial assistance, premium tax credit, and the only way you got this was if you went online to get through one of the various, essentially through the state agency in this state, and to get the coverage. They could have been paying it. Whether or not how much they pay is within limits when you actually create your tax return, because that's the point at which you figure out what your income was. And your income is dependent on how much of the premium tax credit you actually got. So if you are under, it's refundable. If you're over, you're going to pay it back with the tax return. So, but as I said, that was strictly limited there. So, and if you got the coverage through one of the state healthcare sites and so forth, you're going to get what's called a 1095 from them, which is actually put on your tax return. So, now for the commercial. So, how you prepare your tax return this year is up to you. Obviously, we've got TurboTax, H&R Block, both provide tax programs that you can use. There's any number of others that are available. There are a number of commercial internet sites. The IRS has a pre-file program. And finally, they even provide fillable forms for you. So, essentially, IRS.gov pre-file is where you find out about these. However, the rules essentially this year, you've got to have less than $64,000 adjusted gross, and they also have age limitations. They tend not to cover seniors, and even more so, they tend not to cover Washington residents, because the big thing that they're after is to be able to charge you to prepare a state tax return.
Do they cover people who have rentals? Free?
You're filling out the form, you're essentially preparing your own tax return. And so I don't know if they will cover rentals or not. Get into these at all, because as I said, virtually all of them, I don't know off the top of my head of any of them who cover Washington residents. So, or the income is very, the income is relatively low. So, on the other side, the pre-file total forms are available online. The forms will do the arithmetic for you, but you've still got to know enough about tax law to know where to put the various things. You're essentially reading Pub 17, trying to figure out where stuff goes. The alternative to that is my pitch. So, essentially, the people that prepare tax returns through the IRA Tax-Aide program, or the AARP Tax-Aide program, so forth, they all have to take a fairly complex test. And in that process, not only that, but they have to pass that test with at least an 80% correct. So we use a professional tax program and so forth to prepare the return. This year it's going to be a little bit harder because we have changed tax programs. The tax program we've used for the past 20, 25 years lost the bid this year. And we're working with a new one that any number of us are grieving over. The big thing is there is absolutely no charge to prepare that return. Okay, including, in fact, e-filing is virtually mandatory. The big thing is we can't do complex Schedule Cs. In other words, you have business income or relatively complex Schedule D, or any rental properties. Now, we do business returns providing, one, the business is profitable, you have less than $25,000 in expenses, and you don't have any employees or inventory. So, we've got a whole bunch of sites in Kitsap County. Most of the sites are limited to somewhere between 8 and 12 hours a day. The Silverdale site moved last year, and so forth, from the community center to Golden Tides. They're there from 10 to 2 on Tuesdays and Thursdays. So we have 3 more here in Bremerton. We have 1 in Poulsbo. We have 2 in Kingston, 3 in the South Kitsap area, as well as 1 in Bainbridge. So we're one of 23 districts in the state. Last year, we did over $50,000, or almost 50,000 returns. Nationwide, the Tax-Aide program, which is the largest pre-tax preparation program in the country, did some in excess of 2 million returns. So here's the list of all of the sites and so forth, and the addresses and times. And you also have the option, of course, of the professionals. H&R Block and Liberty are the 2 most prominent. Jackson Hewitt typically shows up in Walmart stores. There's well in excess of 50 independent tax preparers in this county.
Can you go back one screen?
Now,
Wednesday and Thursday here.
Right.
Yep.
9 o'clock until 2 o'clock on Wednesdays, 9 till 1 on Thursdays.
Don, is there a printed flyer?
This year I did not print out this thing. One, because you can't hardly read the size that I printed at. However, my email address is talldon@wavecable.com.
Don.
Tall Don.
Where's the short form?
TALLDON@wavecable.com. Anybody that sends me an email, I will be happy to send. I'll send you a PDF file with all of these slides on it.
Question, I've never, with the federal government's board track record for security, I've never felt comfortable doing an e-file. Do you do printouts?
God bless the fellow agrees for it.
Yeah.
The mandatory paper return will do it, but if it's strictly personal preference, no.
Okay, so what you do is e-file.
We e-file. That's what the IRS program is set up.
I prefer doing paper, but that's good to know. Thank you.
The situation there is actually the server that we are talking to when we prepare the return happens to be in Georgia. So the entire return is prepared over the internet.
Oh, really?
And in fact, you will find that all of your commercial preparers are doing very similar things. So if you think that, your only choice, if you're really that worried, is to prepare it yourself on a piece of paper.
I will. I like hard copy. With that much confidential information, I like hard copy.
So, well, we will print you a copy of the return that we prepared.
Yeah, you can print it out and then the person can mail it.
No.
No.
Because we will still e-file the return.
Okay.
The whole reason for the Tax-Aide program, we are supported by the IRS. In fact, the IRS is who provides us with the tax program.
Gotcha.
They're paying for that tax program.
Sure.
And what's happening, if you paper file the return, when they get it, they've got to have somebody who sits down and types that whole thing into the same program that we're using. Okay? And so you're relying on the accuracy of that well-paid person to type in your return correctly. Whereas when we prepare the return, it is checked for accuracy at that point in time. So, and it's a 256-bit encryption that occurs in our machine and does not get decrypted until it gets to the other end. So the fact that there is anybody cracking your tax return, there's a whole lot of other people they'd rather crack than yours. That's also correct, and so forth. Not only does the one person who prepares the return, but a second counselor comes along and makes sure the first one didn't make any mistakes.
That's good.
And for what it's worth, the Tax-Aide program is somewhere in the neighborhood, it's in excess of 99% accuracy,
Good.
which is better than the professionals. So.
Isn't that quality review person sitting right over there?
So,
That was under the old program. Good software, I mean, this is going to be an interesting year.
anyway, like I say, the other thing is you go to a professional, they have to e-file as well. They are required to e-file a return. So the IRS really wants to get out of this entry stuff from paper returns. We will do a paper return if there is no alternative to e-file. So
If you want paper, do it yourself.
but other than that, you have to be separate. So, and I will say that when I worked for the CPA, we used to get any number of people that would show up with last year's return they did on TurboTax. Okay, they prepared themselves on TurboTax. We could almost guarantee that at least 1 out of 2 of those returns would end up with an amendment, which was more income to us. Would end up with an amendment because last year they used TurboTax. So if you don't know the tax law, okay, it is extremely difficult to prepare a tax return. Unless you have, you've got nothing but W-2s or 1099-Rs and so forth, then no problem. But if you've got anything else involved, you're there. And with that, I think I'm done, except that unless there's any questions. I'm done.
We're running out of time.